If I want to buy a car, I can drive it home today. If I shop online, almost anything I buy can be delivered tomorrow. So why is it that when I want to purchase life insurance, I was told the process can take anywhere between 30 and 60 days to complete? So I did a little research on the internet, and what I found was that you can buy life insurance and you can get coverage all in about 15 minutes. In fact, you can get up to $250,000 of life insurance coverage 100% online and sleep easy knowing that your family is protected from the unexpected. You see, I went to American National Insurance Company's consumer site, AnacoDirect.com. The process was easy and I was covered from the moment I was approved online and paid my first month's premium. Best of all, American National has been around for over 100 years and served millions of policyholders. Why is this important? Because now you can purchase life insurance in 15 minutes, online, with confidence, and get on with your life.
Coverage is subject to age limitations and acceptance is based on a few simple health questions on our online form and first premium payment.
Well, hello everybody. This is Dave Cutler again, getting back with you into part 2 of our 7-part series on financial freedom. And today what I'm going to talk to you guys about is life insurance. And the question that a lot of people ask is, do I need it, or do you need life insurance? The way to figure this out is if somebody depends on your income. Basically, if you were to pass away and your family would be financially devastated by that loss of income, then you need life insurance. Examples: married, kids, mortgage debt. You should definitely have something in place to protect your family if your paycheck were to be lost. If you're single and nobody depends on your income, then you probably don't need it. Exceptions would then be if you're young and great health and you plan to start a family later in the future, you could lock in really, really low rates now while you're young and in great shape. I personally have a 30-year term policy that I purchased 4 years ago. Of course, young and in great shape. I pay next to nothing for that coverage, and I know I'll be needing it eventually as I start a family in the future. So I wanted to get that taken care of while I was young, healthy, and could qualify for the best rates. So the crash course in life insurance basically goes as this. There's two kinds. You've got term insurance, and then there's everything else: whole life, universal life, variable life, flexible premium life, equity index life, get a life, you name it, they're all out there. These are insurance policies that combine savings and insurance together. Generally, you pay much, much more for your insurance premiums, with the hope that your coverage will stay in force for as long as you pay the premium. This is known as permanent insurance. Term insurance, which is the most basic type, plain vanilla insurance, basically provides a death benefit. If something were to happen to you, the company is going to pay out the face amount of the insurance policy. The benefits of term insurance is you can generally get your premiums very, very low. Policy terms can be up to 35 years, and these follow the theory of decreasing responsibility, which basically looks like this. In your earlier years, you may have a lot of liabilities, young children, your debt is high, you've got a big mortgage. A loss of income would be devastating, especially in today's society where pretty much most families are dual income families where the husband and the wife both have to work. 20, 30 years from now, the kids are going to be grown up, the mortgage is going to be paid off, the debts are going to be little to none, and your retirement nest egg should be big enough that you no longer need that insurance protection. Go ahead and cancel that policy, because there's no reason to pay for something that you no longer need. So how much do you need? Of course, the rule of thumb that most financial experts go by is 10 to 15 times your annual income. Of course, you can come to an exact figure with a proper financial analysis to assure that you're not paying too much money for too much coverage, or that you're not underinsured, leaving your family shortchanged if something were to happen. So what you really want to look at is replacing the income, and make sure that you don't skimp at all in this area, because that sort of defeats the purpose of buying insurance in the first place. So get the coverage that you need, and try to get it at the lowest amount possible, because we all like to save money in that area. This is a basic example of somebody that we sat down with that had a cash value life insurance. They had a whole life policy on the husband and the wife, $150,000 on each. They were spending $218 a month. And generally in these type of policies, you're looking to get back at the end about 50% or so of the face value of the policies. So they had about $300,000 of total coverage, which means 50% of that, they'd get back about $150,000 at retirement age 65. had they purchased a term life insurance policy and kept their investing separate, you can see they were able to purchase much more coverage for their premium dollar. 3 times the coverage for only $67, and they were able to take that $151, invest that separately into a 401k, a Roth IRA, or even a 529 college savings plan. Some of it could have gone in there, but of course at this stage we put it into a Roth IRA, and they could average a 10% rate of return, which is not all that difficult to find. You can see the big difference, a little over $500,000. So, of course, many financial experts will agree with what I've just told you. Don't take my word for it. Do your own research. Eric Tyson put out the Personal Finance for Dummies book, and this basically goes over, save you, hours of time and thousands of dollars just by term life insurance. The only exception would be if you're looking at using permanent insurance for some sort of estate tax planning purposes. You may want to look into it at that stage of the game. So how long do you need it for? Well, you definitely don't need it forever. Many financial experts recommend having it for as long as somebody's dependent on your income. Again, once you have enough savings in retirement, then you can get rid of that policy. Of course, when your youngest child is at least about 23 years old, they should be self-sufficient at that stage of the game. And you know what? Go ahead and drop that insurance policy once you are self-insured and no longer need to pay for it. Of course, don't take my word for it. Please consult with your financial professional to calculate exactly how much coverage you need and for how long. And of course, I can do just that for anybody who wants me to. So hope that helps you all out today. I know it's not the most fun thing to talk about, but it is a necessary tool in making sure that your family's financial future is protected should something happen, God forbid, to one of those income earners that are bringing in money to that family. So please don't hesitate to shoot me an email or give me a call if you have any questions, and I hope I was able to help you all out today. So thanks so much, and we'll talk with you soon.
Hi, my name is Mark Chandick, and I'd like to spend a few minutes talking to you about the basics of life insurance. The purchase of life insurance may be one of the most important decisions you ever make in your financial life. However, it's a decision that most of us will put off until something happens that hits close to home. That's really not too surprising, since we all have a built-in mechanism that avoids thinking about death. But that kind of procrastination can be devastating to a family or business. Let me explain. There are 3 basic questions to be asked, and they have to be asked and answered in the right sequence, or all the answers will be wrong. The 3 questions are: do I need life insurance? How much do I need? What kind should I buy? Let's take them one at a time. First, do I need life insurance? The quick and easy answer is that if someone will suffer financially when you die, you need life insurance. That could mean your family, perhaps aging parents, or maybe even your business partner and employees. Sometimes we might be inclined to say, well, they'll be okay, and maybe that's true. But it's important to remember that we don't get a chance to change our minds once we're gone. We need to face reality while we can do something about it. The second question is, how much should I have? Some experts recommend a rule of thumb that runs anywhere from 5 to 20 times your annual income. Obviously, with that kind of spread, the rule of thumb isn't very helpful. So how do you determine if you need $100,000, $250,000, $500,000 or more in life insurance coverage? The best way to figure out what you need is to have an insurance professional conduct what's called a financial needs analysis. Here's how it works. You'll start by gathering all of your personal financial information and estimating what your family members would need after you're gone to meet their financial obligations. To calculate this figure, you'll need to think through 3 types of expenses. First, your immediate expenses, such as funeral expenses, uncovered medical costs, taxes, and outstanding debts you want paid when you die, such as automobile debt and credit card bills. Second is ongoing expenses, which is basically money for your family to live on for a specific period of time. It helps pay for everyday living expenses like food, clothing, transportation, mortgage or rent payments. And finally, life insurance proceeds can be used to fund future expenses, such as money to fund a college or retirement savings plan. After you've figured out your family's needs, you'll then want to tally up all of the resources that your surviving family members can draw on to support themselves. This would include things like your spouse's income, savings you've accumulated, and any life insurance you already own. The difference between your family's needs and the resources in place to meet those needs is your need for additional life insurance. Let me share a story with you that illustrates the value of properly calculating the need for life insurance in a very powerful way. Early in my career, I was working with a physician in Southern California who was very busy and didn't give me any time to help him determine the amount of life insurance that was appropriate for his family. Rather, he asked me to simply sell him a $500,000 policy. I complied with his request, only to read several months later that he had been killed by a hit-and-run driver while changing the tire on the side of the freeway. I took great pride in being able to deliver the much-needed cash to the family, only to be shocked to learn that the doctor had 9 children, 3 of whom were in college at the time. I distinctly remember sitting in a room with his wife and all of his children when they collectively asked me, "Is this all there is?" I felt badly that I hadn't found some way to break through to the man and convince him to approach the process the proper way. I vowed never again to shortcut the process and to always calculate the real need for life insurance. I never have shortcut the process since, and you shouldn't either. There are no do-overs with life insurance. There's nothing more important than buying the right amount of coverage, and you need to get it right the first time. So after you've figured out how much you need, you're now ready to focus on what kind to buy. There are 2 fundamental considerations that go into answering this question. First, how long will you need the insurance? And second, how much money do you have in your budget for this expense? The how long you need it question will help you decide if you want term insurance or permanent insurance. Term insurance lasts for a specified period of time, say 5 years or 10, 20, or maybe even 30 years. If your only need is for funds to pay off a 20-year mortgage at your death, a 20-year term policy would probably be the answer for you. Or if you're concerned about providing funds to take care of your aging parents in their later years, a 5 or 10-year term policy might do the job. The shorter the period of time the policy lasts, the lower the premium. But once the term period is over, you'll have to pay a considerably higher price to maintain it if you want to do so. And you may well have to take another insurance physical to qualify all over again. That means your health must still be good and that you haven't taken up piloting, skydiving, or vehicle racing. Declining health or a dangerous job or hobby can significantly increase the cost of insurance and sometimes can make coverage unaffordable or even unavailable. That leads me to the second kind of insurance, permanent insurance. Permanent insurance is what the name implies. It's with you for life, no matter how old you are when you die. The premiums are projected to remain level over your lifetime, and in some cases can be designed to stop at retirement while your coverage remains in force for life. Permanent policies build a cash surrender value that is available if needed in the event of emergencies, opportunities, or college for the kids. Of course, these benefits come with a price. The initial premium for permanent insurance is 3 to 10 times higher than it is for an equivalent amount of term insurance. So if your budget is limited, be sure you buy as much as you need, even if it's all term insurance. But if you have some room in your budget, it usually makes sense to include some permanent insurance in your program. And as time goes on, it will probably make sense to convert some of your term insurance to permanent insurance. You know, one of the biggest mistakes I see my clients make is underestimating how long they'll need life insurance. This was painfully true immediately for many after the dot-com bubble burst in 2000. All of a sudden, you had people who experienced a significant loss in their retirement assets, and they were no longer able to retire on time. Life insurance fills the financial gap that exists between your financial needs and your financial realities. The fact that people had to work additional years necessitated owning life insurance for a longer period of time, and many were caught unprepared. By owning both types of life insurance, term and permanent, you're better prepared for the unexpected things that happen in life. Let's face it, our financial lives never go as smoothly as the financial press would have us believe. So far, we've looked at life insurance from the context of your personal needs. However, life insurance is a tool that is also utilized by almost every small business in America. Businesses, especially smaller, closely held businesses, utilize life insurance to protect their companies in case of the premature death of an active owner. Life insurance is used to purchase a deceased partner's interest and provide an income stream to the surviving family. Life insurance also may be left to the company to provide a financial cushion to the company in the case of a loss of an active owner or key employee. Life insurance is also utilized to provide cash to equalize the inheritance of a family, where only one of the children inherits the company. And finally, to provide cash to pay federal estate tax, so that the company doesn't have to be sold to pay the tax liability. These uses of life insurance keep businesses in business, families financially secure, and Americans employed. So there you have it. A properly designed life insurance program is as essential to a sound financial plan as a strong foundation is to a home. Do it right, and the future is secure.